All right, today we're going to take a really close look at the financial core of a true healthcare behemoth, UnitedHealth Group. You know them by their ticker, UNH. Now, this company has a market cap in the hundreds of billions. It is an absolute giant in its field. But here's the big question. Is it possible this giant is actually being overlooked by the market? Let's dive in and see what we can find. And that's really the core mystery we're trying to solve here. You see, when a company gets this massive, it's pretty easy to just assume that its price is, about right. But what if the market is missing something big? We're about to walk through a valuation model that suggests UnitedHealth Group might just be one of the most undervalued giants out there today. Okay, so before we get lost in the weeds with all the numbers, let's just start with the basics. Who exactly is UnitedHealth Group, and what is it that makes them such a powerhouse in the healthcare industry? So this right here is where we're starting. This is the raw data that's really the foundation for our entire analysis. It gives us that high-level 30,000-foot view of the company, everything from its main business to its key financial stats. Let's break down what it's telling us. UnitedHealth Group is way more than just a health insurance company. It's this big, diversified healthcare machine. So on one hand, yeah, you've got UnitedHealthcare, the insurance side that everyone knows. But the other crucial part of the story is Optum. Optum is a whole ecosystem in itself, providing health services, data analytics with Optum Insight, and even pharmacy benefits through Optum Rx. This diversification, it's absolutely key to understanding how the whole UNH machine works. The numbers here are just, well, they're staggering. We are talking about a company with a market capitalization over $300 billion and pulling in nearly $423 billion in annual revenue. And that all boils down to over $21 billion in net income. I mean, seriously, this is the kind of scale that very, very few companies on Earth can even come close to. So, we've established that UnitedHealth Group is just massive, right? Now, let's do a little health checkup on the company's finances. We're going to dig into the three main financial statements to see if the company's fundamentals are as strong as its size suggests. First stop, the income statement. And this top-line number is a real jaw-dropper, $422.82 billion in revenue over the last year. That's the total amount of money the company brought in before any costs are taken out. It's just a testament to the incredible size and reach of their business. An income statement really tells a story. It's not just one number. It's a detailed play-by-play of a company's profitability over time. It shows you everything from that huge top-line revenue number all the way down to the bottom-line net income, giving us a really clear picture of how much money the company is actually making. Next up, we're looking at the balance sheet. Now, think of this as a snapshot in time of what the company owns versus what it owes. As of the last quarter, UnitedHealth Group was sitting on over $308 billion in total assets. That's everything: cash, investments, buildings, you name it. It is a massive pile of resources. The balance sheet is such a fundamental tool for understanding a company's financial footing. It works on a really simple but powerful idea. Everything a company owns, its assets, has to equal what it owes, its liabilities, plus the value that belongs to shareholders, which is its equity. It's like a financial photo that gives us a clear picture of the company's overall stability. And that brings us to the cash flow statement, which, in my opinion, is where you see the real money moving around. The most important number here is usually the operating cash flow. And for UNH, that number is almost $29 billion in the last year alone. That is a huge amount of actual physical cash being generated just from its core business. Profit is an important number. But at the end of the day, it's cash that keeps a company's lights on. The cash flow statement is the ultimate reality check. It tracks the actual money flowing into and out of the business, from its operations, its investments, and its financing activities. It's a critical indicator of a company's health and its ability to stick around for the long haul. Okay, so we've seen the incredible scale and the pretty solid financial health of UnitedHealth Group. But what does any of this mean for its stock price? Well, in this next section, we're going to dive into the world of valuation and try to answer that ultimate question. What is this company really worth? So a classic place to start is the price-to-earnings ratio, or PE. The trailing PE, which is based on the earnings it's already made, is sitting around 15.6. But what I find more interesting is the forward PE, which is based on what analysts think the company is going to earn in the future. And that number is lower, down around 12. What does that suggest? Well, it suggests the market is expecting UnitedHealth's earnings to grow. This detailed breakdown gives us a much richer, more colorful picture of the company's valuation. And as you can probably see, it's not all perfect. There are actually a few little warning signs here that we probably need to pay attention to. Now, this is a really important point. Even though UNH is this massive profitable company, this analysis is flagging key things like gross and operating margins with a warning. That might mean the company is facing some headwinds when it comes to turning all that massive revenue into actual profit, at least when you compare it to its own history or maybe its competitors. All right, now we get to the real heart of our analysis. We're going to go beyond those standard valuation ratios and take a much deeper look at UnitedHealth's intrinsic value. And we're going to use a pretty powerful tool to do it, a discounted cash flow model, or DCF. So what the heck is intrinsic value? Well, think of it as the true value of a company. It's based on all the cash it's expected to generate for the rest of its life. It's a way of trying to look past all the daily noise of the stock market to figure out what a company is fundamentally, truly worth. Of course, any financial model is only as good as the assumptions you plug into it. So for this one, we're being pretty reasonable. We're assuming a steady 5% revenue growth rate, a fairly low cost of capital at 5.9%, and a conservative long-term growth rate of just 2%, which is basically in line with how the whole economy is expected to grow over the long run. And here it is, the moment of truth. On one side, you have the calculated intrinsic value from our model, over $623 per share. On the other side, you have the actual market price on this date just under $337. That is not just a gap, folks. That's a chasm. It's a massive, glaring difference between what the model says this company is worth and what the market is actually paying for it. The conclusion from this DCF analysis is pretty clear and pretty compelling. Based on these totally reasonable assumptions about its future, UnitedHealth Group's stock appears to be significantly undervalued by the market. This suggests there could be a major opportunity here for investors who are willing to look past the current share price and see the long-term potential. So our DCF model is screaming that UnitedHealth Group is a bargain. But is that just one model's opinion, or is there a wider agreement that supports this idea? Let's take a look at what the professional analysts on Wall Street have to say. Well, what do you know? It turns out our model is not some lone wolf. The vast majority of analysts covering UnitedHealth Group are also really optimistic about the stock. I mean, look at this. Out of the 26 analysts we see here, a full 18 of them rate the stock as either a buy or a strong buy. That is a pretty powerful vote of confidence from the pros. And this brings us right back to where we started. The average analyst price target is $626, which is almost identical to the intrinsic value we just calculated. So we're left with this huge question. When a company's calculated value and the Wall Street consensus both point to a much, much higher price, what does that really mean for its stock? Is this a massive opportunity staring us in the face? Or is there something the market knows that the models just don't? That, my friends, is the billion-dollar question.